Hey guys, I'm gonna get right into this. I'm gonna try to keep this relatively short. It's not gonna be my typical format of being a short video, like an actual short. So probably 4 or 5 minutes long. You can obviously bail out whenever you want, but I just thought I'd share some of my experience investing over the 20 plus years I was on Wall Street. So I'm gonna start with the Great Recession. I was lucky enough to pull my money out, not at the all-time highs, but I was lucky enough to pull it out certainly before we got down to 50% negative returns on the S&P 500, for example, during the Great Recession. And so, I also will admittedly say that it took me a little bit longer, maybe than the average bear, to get back into the market. I didn't get back into 2012. So what happened in between the Great Recession and 2012? So in 2010, the market went up. I want to say it was like 30 something percent. 2011, it was down. I think it was single digits. Somebody can correct me if I'm off a little bit, but I'm pretty sure it was down. 2012, the market was up mid 20%. Same thing in 2013 and so on. Since then, we've had a couple down years, but more realistically, we've been just going up. It's gone. This bull cycle has gone on longer than just about anyone would have ever guessed. Especially coming off such a dark period in the U.S. economic history, for lack of a better way to say it. And having been an institutional investor and a financial advisor, I saw plenty of people that the whole Great Recession pretty much crippled how they acted and invested going forward. And what I mean by that is they just perpetually stayed on the sidelines, and so they've missed out on 4, 5, 6x in gains on the S&P 500 over the last 10 to 15 years. Life-changing money. It's going to affect your retirement plans. It affects a lot. Why am I mentioning all this? Well, I've seen a lot of content creators talking about a bubble potentially developing in the Pokémon market. That's fair. Again, I'm not I'm not an oracle. I don't have a crystal ball. But what I would say to that is, let's say that you started investing in 2024, or even let's just say you're a recent investor, and let's say you started in maybe December, early this year. You could be up anywhere from 20 to 50% already. So let's say that the market takes a downturn. A typical bear market is defined by being down at least 20%. So let's say we fall 20 to 30%. You're most likely either going to be still slightly net positive on a return basis. Maybe you're breaking even, or maybe you're slightly down. You're probably not doing so poorly. If you started investing in the last few weeks, it might be more meaningful in terms of negative returns. But what I would say is, there's a point to this. The ebbs and flows in the market are normal. Bear markets don't last forever. If you're planning just to make a quick buck or scalp things, go buy them from Target and try to flip them quickly, with that type of business strategy, yeah, you might be in some trouble if we run into a bear market. And similarly, if we have like the Great Recession, which, by the way, took 5 full years to recover and eclipse all-time highs. That, by the way, is above average. There's a reason why it's called the Great Recession. It took a lot longer for the market to recover and then start making all-time highs again. But that, again, is not the norm. Typically, again, it's 9 to 18 months. So, yeah, there's always a risk when you're investing. You need to have a business plan, what your strategy is, how much you're allocating of your overall wealth towards your strategy, all that stuff. And you need to be at peace with what you're willing to lose. And one of the first questions I asked, for example, when I was a financial advisor, I would ask people, hey, if the market were to drop 10% overnight, would you lose sleep the next night? Would you be trying to call me first thing in the morning, asking what's going on, wanting to pull all your money out of the market? Those are all things that you should be covering with your advisor. What your investment horizon, time horizon is, what your risk tolerance is. All those things kind of combine into how you're going to react if the market starts to melt down. If you're sitting here thinking like, well, dang, man, if the market falls 20, 30%, that's going to be crippling to me, then you're probably doing something wrong. Similarly, if you have a very specific strategy where you're scalping, you're trying to make a quick buck, it's always going to be risky with that type of strategy. But if you're someone who has, 3+ year time horizon, chances are, worst case, you're probably going to be break even after 3 years, most likely if we enter a bear market in the near term. And you're going to have the whole opportunity cost of your money kind of basically being dead money, sitting on the sidelines, basically doing nothing in the Pokemon space. But here's the thing, if the Pokemon market is down, there's a really strong chance that other asset classes are down as well, meaning there's really no safe place to hide. All these markets tend to be correlated, meaning they tend to go up and go down together. They're not going to go in lockstep. Depending on how risky it is, it's going to move down more if it's more risky, and it's going to move down less if it's less risky. But you should have a plan in mind. You should also understand that if you've already locked in, at least on paper, 20, 30, 40, 50% gains, if the market does go down into bear market territory, you're still not doing poorly. The thing that you have to worry about is, well, how long is it going to sit there basically doing nothing? And then you also, maybe it gives you a little bit of peace of mind to know that most likely you're probably not going to be doing better in another asset class. These are all things that you need to be thinking about in terms of if the bubble were to quote unquote pop. The flip side to all that is, going back to those investors that, their whole psychology in terms of investing changed because of the Great Recession, where they just never felt comfortable being invested in the markets again. And they were really even having a hard time keeping up with inflation. And that's also a really, really, really bad state to be in as well. So you need to be thinking about how much you want to allocate to the space of Pokemon investing. I could certainly make content. Again, this is like in my wheelhouse about the rules of thumb, about how much you should be investing through alternative asset classes, such as Pokemon investing. But more importantly, you don't want to be missing out on perpetual gains. And right now, the whole trend is your friend thing, it's real. And it's going to take multiple different catalysts to reverse course. It's not going to be any one thing that's going to see us drop and stay at lower levels. It may drop the market, kind of like what we saw last fall, where we dipped, and then we had pretty much a V-shaped recovery, right? Like there wasn't enough there to keep the market down. And we've also seen that in the equity markets, right? We've seen some ebb and flows over the last 15 years. There's been some volatility, no doubt. But there's never been a moment where the market stayed down for 3 to 5 years like it did in the Great Recession. And I think that, anyone that has lived through that, it was pretty obvious that was different. Like that was a uniquely bad situation, and that it was going to take some time to recover. If we find ourselves in that situation, I do think there's going to be enough warning signs where maybe you don't, sell at the peak, but you have a chance to get out 10, 15, 20% losses if you can have that discipline. And remember, if you're like most investors in the space, you haven't invested in the last few weeks, you're still probably up on your investment. And that's not a bad thing. Again, markets ebb and flow. For me, I am looking at this for 5 to 10 years. If it had been the Great Recession, it would have taken a full 5 years just to have broken even if I invested toward the highs of the market going into this potential bear market situation I'm talking about. But 10 years down the road, you're not going to be doing poorly. And again, I can't stress this enough. Other asset classes are going to be doing poorly as well. So as long as you have some discipline, you have an investment strategy in mind, you are taking on an appropriate risk based off your risk tolerance. And again, just ask yourself, like I asked all my clients, if the market dropped just 10%, and 10%, by the way, is not a huge drop. If it dropped 10% relatively quickly, are you going to be losing sleep over that? If you had a financial advisor, are you going to be peppering them with phone calls, or her, asking like, what's going on? What should I do? Like it's worrying you? Then that means you're probably invested into too risky of assets. And those are pretty simple questions to ask yourself as you navigate how to invest in general. It's not just for Pokemon. And again, I'm not your financial expert. I'm not your tax expert, but I have lived through this. I've guided a lot of people, institutional and retail investors alike. And Pokemon's not investing is not that much different. It is easy to say like, hey, I got a 10-year horizon and the market, shits the bed and goes down 50%. Like that is going to alarm pretty much anyone. But if you're truly like, hey, I can just, let this be and let it recover, and don't touch it, that 50% loss is only on paper. You don't have to lock that loss in. You just need to be patient and let it recover. Now, if for whatever reason people wake up one day and say this is only cardboard and this shit's worthless, that's a totally different situation. I don't know how likely that is. It's certainly a black swan event, and then some. But that I don't know really. There's really no way to plan for that other than maybe you just shouldn't be doing this at all if you think that's a realistic possibility. So I would say that if you keep buying into all these content providers trying to like make it out like the sky could be falling imminently, they could be talking you out of looking at this pragmatically, like I'm trying to communicate in this content here, which is if you're already up 50 to 100% plus and the market goes down 20, 30%, you're still not doing that poorly. And most likely other parts of your portfolio and other asset classes are also struggling. So all in all, it shouldn't be that big of a deal. If you're one of those people that's looking for a short-term buck, it's always going to be risky, man. Like maybe you should just get a different business strategy if you're not willing to accept the risk that if the market falls 20 or 30%, like you're basically fucked, like you're over levered. Then that's not the best business strategy for you. But those are questions that I ask myself. I urge you to be asking yourself. And right now, the trend is your friend. I personally, I wouldn't give up and buy. I'm not saying bet the farm right now, but there's really nothing on the radar right now. If anything, we're seeing more people in the space. We're seeing new funds out of Asia that are institutional investors, which are all positive catalysts to see the market continue to go up. To see, just in general, prices continue to appreciate in the foreseeable future. What you should be looking for is real catalysts, not people just kind of spewing shit to the wind, saying the market's going to fall. We need something tangible and fundamental to change the investment thesis via catalyst to show us the market's going to be in a downturn. If that happens, then yeah, you probably should be taking some risk off the table. And it's okay if you don't top tick the market. I'd rather you humbly saying, continue to invest. And if the market starts to fall, maybe you don't sell at the peak, but you sell at a 5 or 10% from the peak and maybe miss the 30 or 40% drop if that's what happens. I mean, it's all hypothetical, right? Then continue to miss another 30, 50, 100% plus type returns that we could see over the next few years. And again, just look at the S&P 500, man. Look at all the people that have missed this tremendous rally since 2009 in March. Ironically, we just came off, I think it was March 9th or maybe it was March 6th, one of the 2 dates, we saw the absolute lows on the S&P 500 during the Great Recession. And a lot of people never got back into the market, certainly not to the full extent they were investing prior to the Great Recession. If you do that, you're going to be missing out on a lot of gains. And we just need to see some structural change to know that like, hey, the market's reversing trend. That's what you should really be focused on. And sticking to your discipline, sticking to your investment strategy, you obviously need to have one. If you don't have one and you're just going out buying shit and not really having a plan, that's not going to work out in any asset class. There's a reason why 95% of people that day trade, for example, in the equity markets fail. It's hard. There's a lot of sophisticated people out there that always seem to have an edge over us average Joe Schmoes. But over the long term, if you have a plan and an investment horizon and you stick to it, you should be fine. So again, you can be cautious. You can be looking for the warning signs, but just sitting here saying, I'm going to pull my money out because some people think a bubble is happening. You could have said that on any given year over the last 16 years in the S&P 500. Literally. I mean, having lived through that and all the investors that were jaded by that and scarred by it, so easy to say like, next year is going to be the year, man. It's going to be another 50% fall. It's going to happen. It has to happen. We were up 300%. We're up 400% since the lows. Like certainly we got a reverse course sometime, right? Like this is crazy. Just hasn't happened. And if it did fall, 20, 30% in the last 15 years, and that happened once or twice, it was a pretty much a V-shaped recovery because there just wasn't enough there to keep us down. So sorry for the long video. This actually went longer than I thought it was going to go, but if enough people say that it's true that a bubble happens, you know, again, people trade markets, right? Like we're not robots. Like people listen to other people. And if the psychology changes and everybody all of a sudden says, let's jump ship, you know, then it's kind of self-fulfilling. But until we start seeing, you know, the psychology of the market changing and some catalysts happening, I would be investing. That's what I'm doing personally. I am putting my money where my mouth is. Just keep an eye for the warning signs, and be smart about stuff. Like this really, it doesn't have to be hard. That's my perspective. I've gone through this. I've learned a lot of hard lessons to earn this knowledge. I hope this was helpful, and best of luck out there. I hope you guys continue to kill it.